Hello, I'm Paul Gorrie from the Navigator Network, the current Australian Firm of the Year with the Now Infinity Group, consisting of over 300 accountants and financial planners in Australia. From 1 July 2016, a new form of withholding tax will apply when foreign residents sell certain assets that relate to land and buildings located in Australia. These new rules will have an impact on both parties involved in the transaction in terms of cash flow, reporting requirements and contract negotiations. This new withholding tax has come about because the Treasury Department in Australia recently noted that while non-residents are required to lodge an income tax return in Australia and disclose capital gains made in relation to assets that are classified as taxable Australian property, compliance with this obligation is currently very low. While the Commissioner has a number of powers that can be used in order to collect outstanding tax liabilities from non-resident taxpayers, these are difficult to apply when the funds from disposing of the asset have been transferred out of Australia and there are no other assets in Australia to meet the tax liability. This is why we have a new withholding tax on property transactions. To address some of the problems that have been faced in ensuring that non-residents comply with their Australian CGT obligations, the Australian Government is implementing this new withholding tax. The new rules impose an additional obligation on the purchaser to withhold 10% of the purchase price and paid this to the ATO when certain forms of property have been purchased from a non-resident. The new rules apply to contracts entered into after the 1st of July 2016. While the new rules apply to taxable Australian property, the new rules do not apply to all properties and there are some specific exclusions. The main exclusion involves property with a market value of less than $2 million, and this will ensure that most residential property will not be subject to these new rules, even if the vendors are non-residents in Australia. Where there are a number of purchases, the market value of all the interests will be added together to determine whether the $2 million threshold applies. The new rules are a little more complicated than this, however. We're talking about Australian tax law here now. If the asset involved is property in Australia, the vendors will be treated as non-residents unless a clearance certificate is obtained from the ATO certifying that the vendor is not a foreign resident for the purpose of withholding tax. That is, the purchaser must assume the vendor is a non-resident unless a clearance certificate is produced. So as long as the vendor can provide this certificate to the purchaser on or before settlement occurs, there is no need for the purchaser to withhold anything. This means that all Australian resident vendors need to apply to the tax office for a clearance certificate if their property is worth more than $2 million. The vendor can apply for the certificate any time they are considering selling a property, and the certificates last for 12 months. The ATO has been developing an automated process for issuing the certificates, and the ATO expects the certificates to be issued within 14 to 28 days. The ATO has the power to vary the amount that is payable under these new rules also. Either the vendor or the purchaser may apply to the tax office to vary the amount to be paid to the ATO. Circumstances where this may apply, including the foreign resident will make a loss on the sale of the property, when the foreign resident has carried forward losses, and when there are multiple vendors and they are not all foreign residents. The tax office are implementing an online application process to enable the lower rate of withholding tax. The tax office believe they will take 28 days to respond to these variations if they have all the relevant information required. If there is to be tax withheld, the purchaser needs to notify the tax office of an amount that is withheld on an approved form and needs to pay the withholding tax to the tax office on or before the date of settlement of the property. The non-resident needs to lodge an income tax return to claim any credit for tax withheld by the purchaser if a refund applies in their case. If you'd like further information regarding this, please email us at cpa@navigatornetwork.com.au. This is Paul Gorrie from the Navigator Network signing off.